Investors are bracing for a miserable stretch of earnings reports that will likely extend the dominance of value shares as corporate America grapples with high inflation and rising borrowing costs. The latest MLIV Pulse survey shows the broad view on stocks remains deeply pessimistic as earnings heat up this week, with most of the 424 respondents expecting the S&P 500 index's slide to deepen. The results signal no relief for equities already reeling from their biggest annual slump since 2008 amid a toxic mix of hawkish central banks, a strong dollar and the specter of recession. Over half of survey takers said they're inclined to invest more in cheaper, so-called value stocks, compared with only 39% 3 months ago. The sector's outperformance versus growth last year was the greatest since 2000 as rising rates hurt expensive sectors such as technology by increasing the discount for the present value of future profits. We do believe that value names will outperform this season as those companies tend to be much more domestically focused and are benefiting from the pandemic recovery, said Jay Hatfield, Chief Executive Officer at Infrastructure Capital Advisors in New York. U.S. companies' announcements start in earnest on January 13 with results from major banks including J.P. Morgan Chase and Citigroup. As ugly as fourth quarter reporting looks to be, subsequent earnings seasons may be worse. Nearly 50% of survey respondents say releases for the April to June period will reflect the most damage from a potential economic contraction. By then, it may be time to exit value, more vulnerable to the economic cycle, and switch back to growth. A key question this season is how resilient profit margins will prove to be in the face of surging costs. Underwhelming early reports, including from ExxonMobil, Tesla and Micron Technology, show there are reasons to worry, while job cuts portend growing struggles in the technology sector. Bloomberg intelligence analysts expect S&P 500 earnings to have fallen 3.1% in the fourth quarter, compared with a year earlier. The S&P 500 Pure Growth Index, which tracks firms in that sector, is projected to post an earnings drop of about 16%, while profits at its value counterpart likely rose 1.4%. We're coming off all-time high corporate margins, and with the inflationary and recessionary pressures in place, we're likely to see earnings roll over, said Anika Trion, a managing director at Van Lanschot Kempen in Amsterdam. Some 31% of survey participants expect cooling inflation to be the biggest positive driver for earnings this period, with slightly lower tallies for cost-cutting and supply chain improvements. Consumer price pressures have ebbed from a 4-decade high, and fresh data due January 12 are expected to show further easing. Yet investors are reluctant to buy in without a clearer read on the Fed. The market trimmed expectations for how high the central bank will push its overnight benchmark this year after data on Friday showed slower than projected wage growth and weakness in services. STDWEK, Chief Investment Officer at Flowbank SA in Geneva, said she's more optimistic about equities as we're close to the end of the tightening cycle and data continues to point to disinflation. Yet, she expects volatility to persist before returns recover in the second half. That echoes the view of fund managers surveyed last month, as well as calls by Wall Street strategists for further declines in the S&P 500 before a rebound fueled by a pause in Fed hikes. Tech firms, investor favorites for much of the last decade, have experienced steep losses. The tech-heavy Nasdaq 100 slumped 33% in 2022, compared with a 9% decline in the Dow Jones Industrial Average, which comprises more value stocks. Big tech job cuts made headlines last season, and no let-up is apparent with Amazon.com announcing the biggest reduction in its history and Salesforce saying it would cut about 10% of its workforce. These cuts and other cost-saving measures may help improve profit margins in the short term, but they also signify growing struggles in the technology sector. Investors will also be closely watching the financial sector, as rising interest rates and inflation could put pressure on banks' margins. The Federal Reserve has indicated that it plans to keep interest rates low, but if inflation continues to rise, it may be forced to adjust its policy. This uncertainty is causing investors to be cautious and leading many to favor value stocks over growth stocks. In summary, investors are preparing for a difficult earnings season as corporate America faces challenges with high inflation and rising borrowing costs. Many investors are opting to invest in value stocks as they tend to be more domestically focused and are benefiting from the pandemic recovery. However, many are also cautious as they wait for a clearer read on the Federal Reserve's interest rate policy and the potential impact of rising inflation on profit margins. As a result, volatility is expected to persist and returns may not recover until the second half of the year.